why the Philippines condo market might be overvalued and what it means for you. Hey everyone, welcome back to the channel. Today we're diving into a hot topic, the condo market in the Philippines. Whether you're already a property owner, thinking about buying, or just curious about real estate trends, this is going to be an eye-opener. We'll discuss rental yields, skyrocketing prices, tax reforms, vacancy rates, and what all of it could mean for the market's future and for your investment. So get comfortable because this one is packed with some insights you won't want to miss. So let's talk about the reality of rental yields. It's not as sweet as they might seem. Now, you probably heard that the Philippines condo market boasts a respectable rental yield, about 5% according to sources like Global Property Guide. But does that figure really hold up? When we really dig into the numbers, let's break it down. Imagine you're buying an average 2-bedroom condo in Metro Manila, costing around 12 million pesos. For that 5% return, you need to rent it for approximately 50,000 pesos a month. Here's where things get tricky. The average salary in Metro Manila is just 27,000 pesos a month, not even close to covering that rent. So who can actually afford to rent these condos? Primarily, it's a small niche group of high-income locals, or most likely foreign renters. The issue here is that this demand pool is very limited. If foreign interest drops or the economic situation changes, you could be left with a condo that's tough to rent at your target price. And it's not just hypothetical. The Philippines government recently banned POGOs, otherwise known as Philippines offshore gaming operators, a big factor in driving rental demand. Many foreigners working for POGOs rented condos or even bought properties, creating a market for high rent condos. With POGOs out, we're already seeing potential consequences. Manila Standard predicts there's going to be a 19% increase in vacancy rates in residential areas. Colliers, a real estate consulting firm, has also reported that POGOs occupied about 20% of office spaces. What does this mean for the condo market? So foreign demand can't keep up. Owners are going to struggle maintaining a rental yield, leading to a challenging situation for those banking on high returns. But there's a mystery around vacancy rates, and this is a major red flag. Now let's talk about a lesser discussed issue, vacancy rates. Take a look around Metro Manila, especially in high-end condo buildings, and you'll likely notice something odd. Many units sit empty. At night, you'll see dark windows across entire floors. Some property listings even offer months of free rent, a classic sign that landlords are struggling to fill units. Here's the problem. There's no official data on vacancy rates in the Philippines, making it difficult to get a real sense of the oversupply issue. We're left with anecdotal evidence and educated guess. High vacancy rates, though, are always a red flag in any real estate market. When a property market has strong demand, vacancy rates are low because tenants are quick to fill available spaces. But when vacancy rates are high, it's often because either prices are too high for the local market to support or because of an oversupply of units. This leads to a risky situation where developers and property owners have to rely heavily on foreign renters and high-income earners. Banking on a small subset of renters to sustain an entire market is risky. And with no hard data, the vacancy rate issue might be a much larger issue or a threat to the condo market than it really appears. Another big issue, condo prices keep rising, but rental rates, not so much. Now let's go back to 2016. In Bonifacio Global City, or BGC, condos were selling around 100,000 to 150,000 pesos per square meter. Rental rates were more or less about 1,000 pesos per square meter back then, giving investors around an 8% rental yield. Not bad, right? In fact, that's incredible anywhere in the world. Today, prices have more than doubled, with BGC condos now hitting over 250,000 pesos per square meter or more. But rents, they've hardly changed, still hovering around 1,000 pesos and often even less per square meter. So while property prices have skyrocketed, rental yields have dropped significantly. So in real estate markets around the world, property prices and rental demand usually follow a balanced pattern. For example, in Japan, where rental demand is high, property prices are closely linked to what people can afford and rent, creating a fundamentally sound market. But in the Philippines, we're seeing a troubling disconnect. Prices are shooting up without any solid foundation of rental demand to support them. It's like building a house on shifting sand. Sooner or later, this unsustainable pattern could lead to a huge market correction. Let's talk about the price per square meter dilemma. Let's get into another unique aspect of the Philippines market. The heavy reliance on price, quote unquote, price per square meter as the primary valuation metric. In many places around the world, property values are determined by recent comparable sales, actual sales prices, not listing prices. But in the Philippines, price per square meter is largely set by developers based on previous projects or what nearby developers are charging. Here's the issue. Listing prices don't necessarily equal sales prices. And without transparent data on real sales prices, many buyers end up paying more than a property's actual market value, leading to an inflationary cycle. Imagine if there were more transparency. Buyers could make a more informed decision and prices would likely stabilize at a more realistic level. In the absence of such data though, people keep paying more and the market keeps inflating without a real basis in demand or affordability. So let's talk about falling demand versus rising prices. Is this a recipe for trouble? Here's where things get really interesting. Back in 2018, developers were selling around 58,000 units in Metro Manila at an average price of 120,000 pesos per square meter. Fast forward to 2023, and unit sales have dropped significantly to 23,000, but the average price has jumped to 220,000 pesos per square meter. Experts predict that demand could drop by another 60% in 2024. Yet new developments are still being priced at over 300,000 pesos per square meter. If developers can't sell at these prices, they'll have to either lower prices or offer hidden discounts, leading to a tricky situation for early buyers who purchase at a higher rates. Earlier buyers in pre-selling condo projects are not going to be happy as they're promised capital appreciation as an incentive to buy early. So the best thing for developers to do is offer discrete discounts to later buyers, keeping the perceived value artificially high. This cycle of high prices, low demand, discrete discounts could create a market environment where values feel artificially inflated. There's also something concerning coming around the corner. New tax reforms. What does this mean for property owners? Let's talk about the recent game changer. President Marcos signed the Real Property Valuation and Assessment Reform Act. This act aims to standardize property valuation based on current market prices, aligning it with international practices. For property owners, this could mean higher property taxes as valuations are likely to reflect the true market value. To ease the transition, there's a 2-year tax amnesty, allowing property owners with overdue taxes to settle without penalties. So property owners are going to have to catch up. But there's a silver lining to this. They're developing a new digital property database that could finally bring transparency to the market. Imagine if we had an MLS or what they call multiple listing service in the US, or something similar to track real sales prices, rental rates, and demand patterns. The big question, however, is whether these extra taxes will translate into improvements for the local infrastructure that's much needed, or they'll simply be an added burden for property owners. So here's the big question. Is the Philippines condo market really as solid as it appears? Rising prices, dropping yields, high vacancy rates, questionable valuations, and now potentially tax hikes? These are all factors that no investors can afford to ignore. If you're already a property owner, it's time to assess your investment. And if you're considering buying, remember that this market might be on shaky ground. With demand decreasing and vacancy rates high, prices could plateau or even fall, especially if tax reform add extra costs to property ownership. But these are the opportunities that I look for. A potential opportunity for savvy buyers. Let's talk about the potential big silver lining here. Many people have speculated about a real estate bubble in the Philippines for a very long time. And after a 20-year bull run, we might finally be moving into a buyer's market. Back in 2004, condos averaged just 25,000 pesos per square meter. By 2024, the average sits around 160,000 pesos, a massive 540% increase. I believe the market may be shifting into a bear cycle, which gives buyers the upper hand. With more inventory and fewer buyers, you can find discounted units or even fire sales. So if you've been waiting on the sideline for an opportunity to buy, this could be the time to find amazing deals. Let's hear your thoughts. Now I'd love to know what you think. Is the Philippines condo market headed for a correction, or are we just seeing a temporary dip? Drop a comment below. Let's discuss this. If you found this video helpful, consider subscribing and hit that notification bell so we won't miss out on any future deep dives. Thanks for watching, and I'll see you in the next one.